Hello, this is Cass Hungerford with the American Association of Private Lenders, and I am proud to bring you Don Pelgrim today to speak to you about evolving with the modern market. It'll take competing to a whole new level, navigating the customer expectations, building strategic solutions, and elevating your capacity in servicing and funding. Attend this webinar presented by Don Pelgrim, CEO of Wilshire Finance Partners, to learn about the evolving borrower, using technology to provide strengths to bridge and boost evolution, leveraging and build strategic relationships to gain a competitive edge. Now, before I hand it over to Don, just a few housekeeping items. We do want to make sure that you have the ability to ask questions throughout the presentation as things come up. So go ahead and enter your questions into that question box, and I will make sure that they get over to Don. If you do raise your hand, he will have moments that he'll pause for me to allow you to speak during the presentation, and he'll just let me know when he's ready for that to happen. But the best thing to do is to go ahead and just pop those questions right into that question box. And that's all I have from my end today. Don, are you ready to go?
I'm ready to go. Thanks for the introduction. I appreciate it.
Absolutely.
Well, welcome everybody to today's webinar on the evolving market. We appreciate you joining today. I do have a couple of housekeeping matters on my side as well. This webinar is just an overview of the topics that we're going to present. It's not a full in-depth discussion, and it's designed for real estate professionals. Obviously, this is not a commitment to lend, and any rates and terms that we discuss here are going to change. Further, the opinions contained in the presentation are just Wilshire's, and may be subject to change as well. So who is Wilshire Finance Partners? Wilshire is a direct portfolio lender. We are the manager of 2 real estate debt funds and a real estate debt REIT. We make private money bridge loans. We lend from $1 million to $7 million nationally, and we are secured by multifamily, 5+ units, and commercial real estate. And all of the loans that we underwrite and fund are placed on the balance sheet of the 2 funds. So we hold them through origination through the time that they pay off. I'm Don Pelgrim. I'm the CEO of Wilshire Finance Partners. I also manage the funds. I'm an attorney, and I'm a former banker as well. So as Kat pointed out, the agenda today, we're going to be talking about the evolving borrower. We're going to talk about new technology and how some of that new technology might provide some strengths in bridge lending, and how the evolution of lending is going to change a little bit. We'll talk about leveraging and building strategic relationships to gain a competitive advantage, and then we'll wrap it up with some closing thoughts. So the initial slide here, we're talking about the borrower market, and it really is a borrower market at this point. Borrowers can pick and choose. There's maybe a little bit too much capital out there chasing too few deals. And however, what we're going to learn today is that price is not always the determining factor or the deciding factor, that preferences can be shaped, and that perceptions and outcomes will shift based on the context in which they're presented. So now we're going to get into a little bit of the philosophy of borrowers, and we're going to be talking about the evolution or the evolving borrower and a couple of different myths of the rational borrower. So we're going to talk about rational choice theory, the rational world theory, bounded rationality, heuristics, satisficing, and how Madison Avenue has been using some of these techniques. So first up, we're going to be talking about rational choice and rational world theories. The rational choice theory indicates that individuals possess the intellectual capacity to identify their preferences, to maximize their utility when possible, and act rationally under conditions of uncertainty when it's necessary, when they need to. Under the rational world theory, rational actors will contract to maximize their own benefit, and in other words, they engage in rational decision making. They're fully informed. They are able to perform complex calculations. They're able to make decisions based on complex variables, and they remain cool, calm, and focused when they make the decisions. However, as we all know, we live in the real world, right? So oftentimes borrowers lack information. They have imprecise information. They may lack experience in certain matters. They may be focused on the wrong information, or they might be focused on information that doesn't matter as much or will not create the greatest benefit for themselves. So we talk about bounded rationality and heuristics. Bounded rationality is limited rationality, and it might be limited at best, or in the worst case, it might be systemically biased one way or another. And again, that's as a result of the lack of information and some of the other things I described, such as imprecise information, focusing on the wrong information, or making decisions based on information that don't maximize their benefits. But what we're going to see is that individual preferences may change based on how the choices are framed. Individuals then, because they've got this imprecise information and they're sort of bounded, they use heuristics or mental shortcuts, and sometimes that may lead them astray as well. Many people do not have the ability to process complex market information, or they don't act on the utility of maximizing those determinations. Sometimes they lack self-control, and ultimately this might lead to what they call the myopic doer over the clear-sighted planner. In other words, a party that looks for instant gratification over long-term benefits. Now, similar to bounded rationality and tying back to the concept of heuristics or mental shortcuts, Herbert Simon, who was a Nobel Prize-winning economist, came up with the theory of satisficing. And that's when people's decisions are bounded and they spend a limited amount of time and effort in making decisions. Essentially what they do is they exert just enough effort to acquire a satisfactory amount, quote unquote, of information about marketplace options. And in a way what they're doing is they're satisficing. So the question then becomes, do the heuristics or the shortcuts, the bounded rationality, and the sacrificing that borrowers do create a systemic bias in their decision making? Well, I guess the answer is perhaps, but there's also another challenge, and that is that even a small amount of detail may confuse or create complexity or overload, and that would be counterproductive for a borrower as well. So the short answer is that all shortcuts are not necessarily bad, but they're not necessarily good either. So how does Madison Avenue take the attributes and the characteristics of these borrowers, and how are they selling to these borrowers? They're using mental shortcuts and the decisional bias as tools when they're doing their selling. So the agencies on Madison Avenue know that preferences can be shaped and profits can be made by exploiting those biases. So the heuristics or the shortcuts, once they're identified, that's how they can be exploited. And there's a couple of different techniques that are being used. The first one is framing. And the perceptions and outcomes of a particular individual will shift depending on the context. So real complicated kind of concept is that different elicitation procedures highlight different aspects of options and suggest different heuristics that give rise to different responses. That's a mouthful, and what that means is that what you say, how you say it, and how the choices are framed trigger different shortcuts and will influence the outcomes. This is sometimes called the decision frame, where decision makers and their beliefs of the acts, outcomes, and consequences are associated with a particular choice. And the example that's used in a lot of these studies is a mug, like a mug for a coffee cup. And on the one side, you've got somebody who's selling that mug, and the perception is that because they already own that mug, that the value of the mug is higher. But that same mug, if you're now the buyer, the perception is that the value of that mug is a little bit lower. So the framing by these borrowers become the justification for present consumption or present decisions. The endowment effect, this is an effect where losses are felt more intensely than the gains. And the couple of concepts here is that people react better to something that will minimize risk. And as we showed with the coffee cup, that the same object may be worth more if I already own it. And what Madison Avenue has done is they've taken costly product options that are more likely to be purchased when a consumer is invited to remove them from a package as it's presented, as opposed to presenting those as add-ons. So if you think of the packages and options on automobiles, oftentimes you might go to a dealership and you're offered the car with all the bells and whistles on it, and it's tougher for that consumer to peel off the options that they don't want as opposed to adding on the options that they may want. So Madison Avenue figured out that that might be a best way to sell that type of product. In the lending context, there are things like recourse, which would be essentially a cost, if you will, on a particular loan transaction. Well, using that same kind of bundling concept, you might respond that we can eliminate recourse by reducing the LTV to a certain factor, and that might have that endowment effect of wanting to tie that recourse to the higher loan to value or the greater benefit. You've got something called anchoring and adjustment. Individuals focus on an obvious or convenient number or event. Although they adjust their perceptions upward or downward, they continue to skew towards an anchor. In the lending world, we've seen this with how pricing is given. So for example, as opposed to putting a rate out at 9%, you might say that rate is 8.9%. And in the borrower's mind, that's about 8%. So that's the anchor. It's about 8%. Another concept is sunk costs, where individuals are reluctant to walk away from the costs that they've got into a particular project, and they might irrationally ignore the additional marginal costs or benefits of additional action. There's an overemphasis on the costs they've got into the project. So an example here might be somebody who just put money into the repair their car, and as opposed to selling it and buying a new one, which might be cheaper in the long run, they continue to plow money into that beater because they've already got a whole bunch of sunk costs into that car. So the concept is that the sunk costs keep people from walking away from a deal. So they'll spend more time, more money, and energy on the quote-unquote investment that they've already made. Another concept is optimism or overconfidence. So for example, with a borrower, they might be overconfident, and that bias moves them in a particular direction because they believe that they'll succeed, and the payment that they've got on a particular loan is irrelevant because the excitement about the project and the success of that project. Something close to that is confidence bias, where there might be an underestimate versus an overestimate of the risk. And a study that was done with students, the students were given accident statistics that said that over 40% of the people between age X and Y would get in a car accident over the next period of years. But when they asked the students whether or not they would get into an accident or any of the people in their class would get into an accident, the overwhelming majority of the students said that, well, I'm not going to get into an accident, but these other classmates will. So they essentially ignored the statistic and the risks associated with that, with this confidence bias that they had. You then have current consumption versus delayed gratification. And the perspective of the borrower is that well-being is tied to present consumption. And few individuals will exercise self-control that's required for delayed gratification. In other words, the need for immediate gratification becomes irresistible, and that's a trait that might be demonstrated in particular borrowers. Another methodology used by the folks on Madison Avenue is the concept of hyperbolic discounting. And hyperbolic discounting means that a higher rate on a short-term loan is viewed more favorably than a lower rate on a long-term loan. And the mindset there is that the borrower believes that they're going to pay off the loan early. And if you think about the payday lending sector of the marketplace, they play on this all the time, right? So it's a matter of convenience and present consumption, and they're willing to pay the higher rates as long as the payment is affordable. But what these folks don't focus in on is the length of time for the repayment, just the monthly payment. You see that in leasing as well, and you see that in other types of financing. The next concept is what they call intertemporal choice. And this is a concept that ties current consumption and hyperbolic discounting, which means that you choose smaller benefits sooner rather than large benefits later. Again, this ties back to instant gratification. So this might be seen in somebody who's willing to take a 12% rate of interest today with less paperwork versus an 8 or 9% rate of interest, but it will take them 20 days to get that particular loan. The last concept I want to cover is the concept of the safety net for poor choices. And you'll see that in things like a free trial period or a money-back guarantee. And in lending, it might be non-recourse loans. And that ties back to the endowment effect, the trade-off of a lower loan to value versus the recourse. And at that point, you're playing on the fear of loss and greed as the two primary drivers there. So what we're talking about now is behavioral decision making, and individuals are not necessarily reliably and instrumentally rational. It doesn't mean that borrower decisions are not predictable. They may be predictable, but they're not necessarily rational all the time, which leads to what you might have in the form of a rational lender and a quasi-rational borrower. So borrowers make up for that bounded rationality or that limited rationality by adopting those decision-making heuristics or the shortcuts that help the borrowers make their purchasing and borrowing decisions. And those heuristics introduce systemic biases into the decision-making. So people start to make poor choices and maybe worse deals because they're relying too much on those shortcuts. And as we learned from the Madison Avenue marketing guys, that mental shortcuts and decisional biases are tools that may be used in selling to borrowers. And the potential there is that you've got lenders who can exploit those predictive and cognitive weaknesses in borrowers. And that's what we saw in some of that predatory lending at one point. So now there are other evolving schools of thought, and these are sort of some more modern thoughts here. And you've got the Dunning-Kruger effect, and psychologists David Dunning and Justin Kruger came up with the concept of cognizant bias and of illusory superiority. So cognitive bias of illusory superiority. And that's the borrower's mistaken belief that their cognitive ability is greater than it really is. And the cognitive ability is the mental ability to reason, problem solve, plan, engage in abstract thinking, and comprehensive and complex information and ideas. And what that does is it impacts the borrower's ability to plan and analyze financing options. It's the inability of the borrower to assess and prioritize the various different variables as inputs when choosing lenders and asking for the right type of loan. Borrowers lack information or experience to make that economically optimized choice. Well, this is kind of an interesting concept, especially in the fast pace and all the facts and fiction that's packed into the world of the internet. But this theory also focuses on information overload and focusing on factors that is not as meaningful as or as impactful as others. So under this theory, there's an opportunity for brokers and lenders to add value to the decision-making process for the borrower and not just merely rely on things like price. It's to get the borrowers to focus on variables that may have greater economic difference in the long run as opposed to little economic difference. And that's especially true in bridge loans, right? Borrowers tend to focus on variables that they cannot predict and variables that have little impact on the long-term financial position. So what lenders can do is that we can help them identify the right variables and help identify the wrong variables. So for example, the focus on interest rates. Earlier this year, everybody predicted interest rate increases, but we roll forward to this part of the year and we've seen a series of rate cuts. Therefore, borrowers focusing in on interest rates are focusing in on something they cannot predict they should care less about it. Conversely, if you're comparing variable rates and teaser rates versus fixed rates, you would have a situation where you have more control. So the issue there is with interest rates, it's the lack of predictability. There's been no consensus among economics or economists on rate forecasts. And if there's no consensus, then how can a borrower really accurately predict them on their own? There's forecast volatility, where rates are always changing. And when rates are changing, that means that the predictability of their direction gets a little bit tougher. And again, how can a borrower accurately predict where interest rates are going to go? And then you layer on there the time horizon. And with respect to the time horizon, there's a mismatch, right? So if you're putting interest rate predictions into long-term models, it creates inaccuracy and mismatches as well. In other words, it's easier to predict rates over a shorter period of time, and that's why economists limit their predictions to a couple of quarters and not over several years. And as time horizons increase, the prediction powers decrease. So looking at long-term rates and trying to model that over a longer period of time, that gets a little bit squirrely. Therefore, it's far better for borrowers to focus on things that they can control in a transaction as opposed to, say, interest rates, such as the current tax implications of a transaction, the holding periods of a particular deal, budgets and costs, the income expenses and NOI growth, and perhaps even the optionality of future financing or sales on the property. So things like the prepayment penalties in a bridge loan versus lock-in periods. So lenders can help borrowers focus in on the variables that they can control or predict with more accuracy. You can get some of the interest rates off the table, and you can focus on those control elements that create the larger benefits. So the takeaways in this segment when we talk about the borrower is that we can recognize and look for the human traits in these different lending situations. You can look for that bounded or restricted rationality, the cognitive bias of illusory superiority, or in other words, the borrower's mistaken belief that they can figure it out, and that belief is greater than it really is, and the borrower's heuristics or their shortcuts. And what we can do is we can get borrowers to focus on the variables that are more meaningful and that they can control, such as the holding periods and budgets and income and expenses, and get them to focus on the real value, which is the prize, that longer-term benefit over the instant gratification that they might be trying to seek. And in other words, you're helping them get to a deal that makes more economic sense. So now I'm going to pivot and I'm going to start to talk a little bit about technology. Well, in the old days, borrowers used to live very, very closely to the banks that they did business with. They might live 10 or 15 miles in a radius around the bank or the branch. The bank knew the borrower, the bank knew the family, and it was small town type of relationships that drove the lending at that point in time. But as you roll forward and you've got expanding businesses and banks looking to expand their footprint, the distance meant less contact with borrowers and the properties and less information, and that led to more poor decisions or bad decisions. So what happened was national lending started to fuel growth in technology, and credit agencies were originally used primarily for credit cards to assist with some of the scoping of the potential borrowers, but wasn't soon after that credit agencies and credit scores started to be used for mortgage lending. When you talk about credit scoring, that's the use of historical data and assigning weights and scores to different portions of the underwriting to make a lending decision. We've all learned about the, the 5 C's of credit, which is credit, capacity, cash flow, collateral, and character, and the weight that each institution places on them would be part of that credit scoring system that they would use. Risk-based pricing models then evolved, and that was using credit scoring, transaction structure, and other elements to assess risk and determine the risk-based pricing for a particular transaction. Now, the problem is when you start to price to risk is inaccurate information. So if you've got inaccurate information, you might start to price higher across the board, And as a result of that, better borrowers don't take your loans, and worse borrowers get on your books and they start to default. So what then does the bank do, or what then does the lender do? Well, they increase their price to compensate for the risk, so it becomes a cycle. So the theory here is that the best approach is to not increase your rates, but to decrease your rates and tighten your underwriting standards so you're focused on the ability and willingness to repay versus the yield on the transaction, and you avoid the higher cost that deters the lower risk borrowers. So going a little bit further and getting back to character, using character as an attribute as part of the credit scoring and the risk-based pricing models is not anything new. But not considering character may cause some credit models to either overestimate the risks of some borrowers. In other words, you might have somebody with a low credit score, but they always pay their bills, so they might be a pretty good credit risk. Or you're underestimating the risks of other borrowers. So you might have somebody with a good credit score, but they're looking for higher leverage with no personal guarantee, which might indicate a willingness to walk away from a deal if it gets a little bit rough. So character is being used to predict borrower behavior in a way that a credit score really can't predict. So in other words, the loss of a job or income, how would that borrower behave? Would they honor their loan commitments? So one of the new theories is that personality and character traits are stable over the years, and how a borrower acted and behaved is there a good predictor of how they will act and behave in the future. But the measurement of character gets a little bit tricky. So this is where some new technology is coming in, and there's some technology that's being built around the concept of what they call psychometrics-based credit scoring. And this is the use of alternative data to improve credit models. They're using non-traditional sources of financial-related information and data to drive these models, and that might include things like mobile payments and internet transactions and payments. And the goal here is to try to figure out the character traits, what's viewed as good for a good borrower, and what are the behaviors that we need to measure here. So ultimately what they're trying to do is they're trying to measure the responsibility of a borrower and the trustworthiness of a borrower through their character traits. And the goal here is to determine the willingness to repay over the ability to repay. An example of that might be, how did a borrower act in the last financial crisis with their lenders? If there was a default because of a refusal to pay versus an inability to repay, such as a strategic bankruptcy, that may give you the an indication of that borrower's character traits, and that might not be somebody that you would want to lend to. So those are the types of personality traits that technology firms are trying to develop and measure in connection with the credit decision. So some of the platforms that are being developed and how they're going about figuring out these character traits becomes interesting. Some of these platforms are using self-reported questionnaires, and these questionnaires are designed to figure out the financial behaviors of these potential borrowers, and then they use proprietary algorithms to profile and pattern the responses, but they're not relying on outside data sources at all. In other words, they're relying on the inputs that they're getting from the borrowers. The challenge is in something like this, and we've experienced this before, is that a borrower can game a questionnaire, right? They can skew their questions in such a way, or their answers in such a way, to make the questionnaire go in one direction or another. But what the psychologists that are doing that are creating these questionnaires is they start to use questions with no right or wrong answers, and then they use algorithms to try to determine what the patterns are to see if somebody's trying to game that questionnaire. But another problem with something like this is the time to complete the application. So questionnaires can be made shorter and they can be completed online, and that might make this type of approach a little bit more palatable for the borrower that is going to be using them. Conversely, other companies are turning to other data sources. So they might be looking at a borrower's education, where they went to school, behavioral factors that are identified in past transactions and payments, psychological assessments like the questionnaires that we described, social media accounts, personal savings and investments, a measurement of the likelihood that they would take risks in certain situations, organizational skills, consistency, and thinking speed. And some of these models are actually reporting very, very good success. One reported that they had a 75% decrease in defaults as a result on the very, very strong focus on the borrower characteristics. So ultimately, what I think we're going to see here will be a marriage of big data and artificial intelligence as part of the credit scoring and risk-based pricing models. So at Wilshire, in terms of how we're approaching all of this, we've developed our internal proprietary risk-based pricing models, and many of these factors that we've described here we take into consideration. Now, obviously, we're not driven by, at this point, psychological analysis. Character does become an important part of that credit process. So for example, with us, we're not driven by credit scores as much, but we do look at a number of other factors on and off the credit report. So going back to the bankruptcy example, what we might do is we'll look at the bankrupt who was honest and unfortunate as opposed to the bankrupt who was opportunistic and was using bankruptcy as a strategy. And we might look at each one of those different scenarios differently. So, we've talked a lot about some pretty heady subjects here. We've got a number of different things from a psychological standpoint. We've got new technology. We've got sort of the old models that we're using. And like borrowers, I think that brokers and lenders are going to have similar challenges pulling all this information together. We're going to lack certain information. We're going to have too much information. We might have incomplete or imprecise information. At times, we're going to lack the time or lack the resources or other factors. So, how do you start to execute on all of these different things? Well, like the borrowers, I think you've got to start to seek strong resources and collaborate. And this is where leveraging and building strategic relationships come in to gain a competitive advantage. You want to start to align with lenders that have good understanding of these dynamics and that can help you close more deals and help you grow your business. At Wilshire, we work with a lot of brokers and borrowers on a number of different levels, and in many cases, we often take the role of an informal consultant as well as a lender on complex deals because we've seen a lot and we've got some different skill sets that are within our company. And what we're trying to do is we're constantly looking for good business partners, good brokers to develop our network. And that's why we do seminars like this and provide information like this to share this information with our broker friends and colleagues to continue to develop that relationship and raise the industry a bit. So in terms of closing thoughts, we've got the rational or the irrational borrower, and those borrowers may focus on elements that can be controlled, or they should be focusing on the elements that can be controlled to maximize their value. The short-term rate on a bridge loan should not be a make or break for a project, but the money that we provide can be a catalyst to realize the other longer-term benefits. So we have to focus on those longer-term benefits and getting them over that bridge to those benefits. That's what it's all about. It's the delivery strategy. Convenience is king. However, borrowers and brokers may still choose a path of least resistance, even if it's not such a great deal because of that instant gratification that we talked about. Conversely, when you're working with borrowers and you're working with companies like Wilshire, we can make those difficult challenges more manageable, and we can make the easier deals easier because of our understanding and the different tools that we bring to the marketplace. So what we have the capability to do is let Wilshire take the laboring oar on some of these transactions so that the brokers that we're working with don't have to put as much time into it or as much energy into a potential deal when we can provide a lot of that back-end leverage. And that allows the broker to leverage our people and our process to facilitate a closing. It's the sales strategy as well. It's becoming the trusted consultant. remembering the borrower attributes and issues, the bounded or restricted rationality, the cognitive bias of illusory superiority, in other words, the mistaken belief that they've got it all dialed in, and that might be a belief that's greater than it really is. And then the borrower shortcuts, or the borrower heuristics. And it's getting them to focus on the elements that can be controlled and to create the greatest value in a transaction. So if you're selling on rate, you may just be another broker. However, if you're helping the borrower to enhance the long-term value and you're structuring your transaction around that, I think you've got a pretty good bet that there's a repeat client there for you as well. And then it's the relationship strategy. It's leveraging the strategic alliances. You don't have to go it alone if you align with good partners. So Wilshire's focus is creating long-term value for our broker clients and their borrowers. And hopefully through these type of webinars and this type of information, we're demonstrating some level of knowledge in the lending industry that can be beneficial to you. And as a result of that, hopefully when you've got transactions, we can become a subject matter expert for you and a partner for you as well. So with that, I want to sort of wrap it up and see if there are any questions that are lingering out there. Okay, there's a question about the 5 C's of credit, and if I can go over those pretty quickly again. You know, the 5 C's of credit are sort of the benchmarks, if you will, for the credit scoring and the risk-based pricing model. And the 5 C's of credit are generally going to be the borrower's character, and as we described, that's their ability or willingness to repay, how they've operated in the past. It would be their credit, and credit is backwards looking. You're looking at their credit reports and how they've managed their credit with other lenders, and that's supposed to be a forward predictor of credit. You're looking at their capacity. Capacity is generally their capability through earnings outside of the property or investments that they've got, and the capability to repay your loan. You're looking at the cash flow, and that would be the cash flow or the net operating income from an income-producing property and its ability to cover the debt service on the loan. And then you're looking at the collateral itself. As a collateral-based lender, we put the greatest weight or the greatest emphasis in our models on the cash flow from the property and the collateral value itself, and less so on the capacity and the old credit of the borrower. But we do, as I mentioned, we do look at the character of the borrower as well. And the reason that we look at it that way is that if you think about it for a moment, you might have somebody who's got excellent character and excellent capacity and outstanding credit. But as we saw in the credit crisis, a lot of people went through that crisis, and the capacity went away, and their credit was shot. Their character didn't change. They had, great character, but they had an inability to pay, and that's how they got damaged through that process. So, as a collateral-based lender, if we're focusing on the collateral and the cash flow from the collateral, that gives us a greater sense of the ability to repay, and that the property will be able to debt service and cover us. One of the questions is, how can we use these techniques to improve our lender and borrower communication? Frankly, I think that gets to some of the questions that you're going to be asking the borrower up front, and it might be things like as basic as needs and wants. They might want something, but they may not need a particular attribute or a particular part of the deal structure. So understanding that up front becomes important. Also understanding the drivers, right? Oftentimes what we're seeing is people are coming to us with unstabilized properties, and the real driver here is not the interest rate on the loan. It's making sure that they can hone in on their budget, make sure that that budget's tight, and they have the capability to get that property back online as quickly as possible. then reduce the operating expenses and increase the revenue so that they've got greater cash flow. That at the end of the day is the real prize, because that's what's going to drive the long-term value in that property. It's not the short-term interest rate on the bridge loan. And when you really start to do the math and you blend the short-term rate on a bridge loan with the long-term rate on the takeout financing, the longer-term financing, it's not a big swing. So if you take interest rates off the table and you're focusing on those other factors, that's one way that you can help to bring the bar around and get them focused on the right attributes and the right metrics to make their decision. Another question, how are you implementing upcoming technology on your platform? We're doing a lot of things on our platform at this point, and we're starting to roll them out. A lot of this is connected with what we call our private label program, which is a program that we've rolled out to some brokers that want to become lenders, and we become the funding engine and the underwriting engine behind them. And that technology has some of the models in place for the pricing and scoping, as well as the use of technology to move documents around a little bit more efficiently and communicate a little bit more efficiently as well. With respect to some of the other things that are coming online, like psychometrics, we're not going down that path as a sort of a questionnaire, but we've been doing that type of analysis and that type of scoping over the years, so that remains part of our credit scoring and our model. How do we partner with Wilshire? There's a number of different ways that you can partner with Wilshire. If you're a broker that's in the business and you're doing one-off bridge loans here and there, you can become an approved broker under our platform. And as you see those deals, as you get those deals, you can present those to us, and be happy to give us or give you our thoughts and how we might be able to get that deal closed for you. For people who are more active and are looking to do a little bit more volume, I have the capability to do a little bit more volume. We have some other relationships like the private label program I mentioned before for those types of brokers as well. And I got to thank you. So thank you for listening in. It was a pleasure to present to you today. Again, we're actively seeking strong brokers out there as partners. We've got plenty of capital to deploy. We'd like to get it out there, and we're looking for good folks to develop relationships with on the long term. So we look forward to hearing from you in the near future. With that, Kat, I'm going to turn it back over to you.
Thank you. And I think we just had one last question come in. What is Wilshire's minimum loan amount from Vicki?
Got it. Okay. Our minimum loan amount, we are generally around $1 million. We might go below that on a case-by-case basis, but we don't dip too far below that. In terms of our maximum loan amount, we're generally around $7.5 million. We can stretch a little bit higher than that when we put our two funds together. And some of this, in terms of the minimums that we've got, is just the efficiencies that we can gather and the ability to cover the costs associated with the due diligence on those transactions. So we do like to keep it around $1 million.
I don't see any other questions coming in, so thank you, Don, so much for joining us today. For those of you who are AAPL members, you'll be able to find a recording of this webinar online within the next few days. In other news, for future webinars, just stay tuned to our emails for both of our regular newsletter and then the special emails that come out for each webinar. And as always, if you're looking for in-person interaction, our annual conference is coming up November 7 through 9. You can go to aaplconference.com and you will be able to register for that there. Thank you so much for joining us today, and have a great rest of your week.
Thanks, Kat. Bye now.